During the 1950s, only about 4% of the US population was invested in the stock market. Not only was information difficult to obtain, but the costs were extensive. Now, we live in a world where technology has given millions access to the stock market for pennies on the dollar. But that doesn't mean fees are completely gone. These finance guys gotta pay their mortgage in the Hamptons somehow. What's going on, everyone? My name is Ash, bringing you the knowledge, perspective, and resources from my world to help you live a better financial life. Today's episode, I want to talk to you about expense ratios and investing fees. This is always a topic of discussion for seasoned and also beginning investors, and I would love to share my perspective and insight on them. And hopefully they can empower you to make better decisions when it comes to implementing your investing strategies. To kick things off, before I would ever start a conversation about fees with any client, I would always start with this statement. Fees matter in the absence of value. When it comes to investing, or anything in life for that matter, the more expensive something is, the more value it tends to provide, theoretically. And sometimes the same thing applies in finance. And the reason why I say sometimes is because there are index funds out there that literally cost $0 that can give you 16% in any given year. Just take, for example, this guy. And other times, a fee structure that can be costly for one investor can provide a great deal of value for another and fill a gap that they had in their strategy. Let's say bonds, for example, or dividend growth, or real estate, all of which require additional research, analytics, and expertise to qualify. To kick things off, an expense ratio is common among ETFs and mutual funds. And I'm not going to bore you on the formulas on how to calculate them, but the important thing to note is that these fees are built into the price per share. So it's not something that you pay separately or comes out of your account on a monthly or quarterly basis. If you recall what an ETF is from a prior video, you can have two different ETFs that track the same exact index, but their expense ratios can differ. Why is that? It's because different asset management companies have different operating expenses to create and maintain these funds. And to give you an example, let's say you have two ETFs that are tracking the same exact index. One has an expense ratio of 0.80 and another at 0.10%. The performance of the index that they were tracking last year was 20%. But if you owned one of these ETFs, your return would not be 20%. It would actually be 19.2% and 19.9% respectively. And it's because of the fees. This would reflect in the price per share, assuming that you bought each at $100 per share. So the ETF with the lower expense ratio would have the higher price per share, therefore giving you better performance. And again, remember, this is assuming that all else is remaining equal with the index tracking and underlying investments. So you can see that even though both are tracking the same exact index, the total return varies. And the ETF with the higher price per share, of course, holds more value. And this illustration shows the importance of lowering your investing fees because when compounded on an annual basis, let's say, for example, 10 to 20 years, you could be paying a pretty nice penny for like performance. But the really nice thing about fees and investing is that now it's becoming more democratized, meaning that investors have more options, more power, and the ability to lower their costs of investing. Now that we have expense ratios out of the way, let's talk about management fees. Management fees are paid to financial advisors or companies to manage overall assets or specific investment strategies. This is slightly different than expense ratios because expense ratios are exclusively for ETFs and mutual funds. Management fees are additional fees that can be added by an advisor depending on which strategies they decide to implement. Let me explain. In exchange for management fees, investors receive specific investment services like active portfolio management, niche strategies like dividend growth, bonds, and holistic wealth management, and advice that can entail tax and estate planning or even retirement solutions. So think of management fees that you may pay an advisor for additional customized wealth management solutions. This is again different from expense ratios because expense ratios are exclusive to ETFs and a mutual fund. Remember earlier how I said fees matter in the absence of value? Well, this is a prime illustration of that. Let's map out an example. Let's say Sally has $100,000 and wants to invest her money. She goes to an advisor who charges 1% of her total assets to manage her money. In other words, a management fee. Sally agrees to the fee because she knows jack squat about investing. After going through the planning process, Sally and the advisor decide that an ETF portfolio is suitable for her. If you recall, ETFs have an expense ratio attached to them. This is of course separate from that 1% management fee that the advisor is charging. The ETF portfolio has an aggregate expense ratio of 0.65%. So when you look at Sally's total cost of investing, she is paying 1.65% on an annual basis. The 0.65 for the ETF portfolio is of course priced into each price per share, and the 1% management fee is being taken out from her account on a quarterly basis based on the amount of assets she has. So on $100,000, assuming her portfolio does stay flat, she will pay about $1,650 in annual fees. And as her portfolio grows, so does that fee. Because 1.65 times a higher amount, of course, well, you guys know how to do math. Fees are a very sensitive topic when it comes to investing, and opinions vary across the spectrum. But I stand by the value proposition that fees matter in the absence of value. So if you are or decide to pay a management fee for investing, just please know what investment services you are paying for, especially if your fee is nearing or above the 1% mark. Also be aware of layered fees. Just like in Sally's scenario, she not only had to pay 0.65% for that particular ETF portfolio, but on top of that, she also had to pay 1% for the management fee to the advisor. Some may say that she's really dumb for paying exorbitant fees, but to her, she is getting great value out of that relationship. Because remember, she didn't know jack squat about investing or where to get started. She is getting a full wealth management relationship with investing resources, so that way she doesn't have to worry about it. To her, that peace of mind, knowing that she has professional resources when it comes to investing, and also knowing that her money is doing something other than sitting in a savings account, that's all the value that she needs. I hope this video gave you a good overview of expense ratios and management fees and what would make most sense for you when deciding to implement your own investing strategies. If it did, be sure to hit that like button and also be sure to share with those that you think might find this information useful. I'm bringing weekly videos on personal wealth management and market insights, so please chime into the comments on topics that you would like to see in a future episode. I appreciate you all tapping in. My name is Ash. I'll catch you guys next time.